Picture this. You locked in a mortgage 5 years ago at 1.8%. Let's start with the numbers, because they're absolutely terrifying. Between now and the end of 2026, roughly 60% of all outstanding mortgages in Canada are coming up for renewal. That's not a typo, 60%. These are people who borrowed money when the Bank of Canada had rates at 0.25%, when you could get a 5-year fixed mortgage for under 2%. They thought they were being smart. They stress tested at the required levels. They did everything the banks and the government told them to do. But here's what nobody explained. In Canada, you can't lock in a 30-year fixed rate like Americans can. Our mortgages reset every 5 years. It's a ticking time bomb built into the system. When interest rates were stable, this didn't matter. But when rates go from near zero to over 5% in less than 2 years, like they did in 2022 and 2023, every single person who borrowed during the pandemic is walking into a buzzsaw. The math is brutal. If you have a $500,000 mortgage at 2%, you're paying about $2,118 a month. When that renews at 4.2%, which is roughly where 5-year fixed rates sit right now, your payment jumps to $2,700. That's a 30% increase for a household earning $100,000 a year. That extra $582 a month represents almost 10% of their take-home pay just vanishing into the mortgage. And it gets worse. About 40% of people renewing are facing increases even steeper than this because they were on variable rates or they locked in at rates below 1.5% during the absolute bottom of the market. Some households are staring down 40% payment increases. The Royal LePage survey from earlier this year found that 81% of borrowers facing renewal expect to experience financial strain, not inconvenience strain. We're talking about cutting groceries, eliminating savings, canceling insurance, pulling kids out of activities. This is the stuff that breaks families apart. So what happens when people can't afford the new payment? Right now, the official line from the banks and the government is that everything is fine. They point to mortgage arrears, which are mortgages more than 90 days overdue, and say, look, it's only 0.20% nationally. That's barely anything. More than 99% of Canadians are still making their payments. But here's what that stat hides. First, it's up from 0.14% just 2 years ago. That's a 43% increase. Second, the regional numbers are terrifying. In Ontario, 90-day delinquencies jumped 71.5% year. In Toronto, they've doubled since 2022. And here's the kicker. These are lagging indicators. People don't miss 3 mortgage payments immediately when rates go up. They drain their savings first, they max out credit cards, they borrow from family. The missed mortgage payment is the last domino to fall. And we can see the earlier dominoes falling right now. Auto loan defaults are at 2.42%. The highest level in over a decade. Credit card delinquencies are approaching 2009 levels. Non-mortgage delinquencies overall are up 29% year over year. This is the early warning system, and it's screaming. Historically, consumer debt defaults precede mortgage defaults by 6 to 12 months. People stop paying the credit card before they stop paying the mortgage because losing your house is the nuclear option. But the nuclear option is coming. Power of sale listings, which is what foreclosure is called in Ontario, are exploding. In September 2025, there were 228 active power of sale properties in the Greater Toronto Area. That's up 59% from the year before. For all of 2024, there were just under 1,200 new power of sale listings. Here's where it gets really dark. When you look at the power of sale data, something strange jumps out. Out of over 3,000 distressed properties analyzed, only 9 were held by Canada's Big 6 banks. 9. Where are the rest of these mortgages coming from? The answer is the shadow banking system, and it's way bigger than most people realize. There's now almost $120 billion in mortgages held by private lenders and mortgage investment entities in Canada. These aren't your traditional banks. These are lightly regulated, high-interest lenders that step in when the banks say no, and they're growing fast. In Ontario alone, private mortgages grew 72% in just 2 years. They now represent 7% of all new mortgages being issued. The people ending up with private lenders aren't criminals or deadbeats. They're self-employed workers who can't prove traditional income. They're people with a minor credit blemish. They're folks who got turned down by a bank because their debt service ratio was slightly too high, and the private lenders charge them 6% to 15% interest. Some of these loans are interest only, meaning you're not even paying down the principal, you're just treading water and paying fees. Here's the nightmare scenario. You buy a house in 2021 with a private lender because the banks won't approve you. You're paying 9% interest. You think it's temporary. You'll refinance with a real bank in a year or two when your income stabilizes. But then rates spike, home prices fall, and now you're underwater. The house is worth less than you owe. No bank will touch you. You're trapped in the private market, paying extortionate rates. And the private lender has zero incentive to work with you because they can just seize the house and sell it. This is why private mortgages are driving the power of sale surge. Let's zoom out for a second and look at the bigger picture, because this isn't just a mortgage problem. This is a total household debt crisis. As of the third quarter of 2025, Canadians owe $1.77 for every dollar of disposable income they earn. Read that again. For every dollar you take home, you owe $1.77. That's a debt-to-income ratio of 176.7%, and it's been climbing for 4 straight quarters. To put this in perspective, the United States hit 100% debt-to-income at the peak of the 2008 housing bubble, right before everything collapsed. Canada is 77% higher than that. And unlike the US, which deleveraged after 2008, cut their debt, fixed their balance sheets, we just kept borrowing. We looked at the American collapse and said, hold my beer. Here's what makes this so dangerous. 75% of Canadian household debt is mortgages. That means our biggest debt is tied to our biggest asset, which is real estate. It's a double exposure. If housing prices fall, which they already are in many markets, people don't just lose wealth, they lose collateral. And unlike the US, where you can walk away from a house in many states and just wreck your credit, Canadian mortgages are full recourse. If you default and the bank sells your house for less than you owe, you still owe the difference. The bank can garnish your wages, seize other assets, come after you for years. You can't just mail in the keys and start over. And here's the really insidious part. To hide how bad things are, the banks have been playing a shell game with something called negative amortization. This is one of the most predatory things I've ever seen in the Canadian financial system, and almost nobody is talking about it. Here's how it works. You have a variable rate mortgage with a fixed payment. Rates go up. Your monthly payment stays the same, but now it's not enough to cover the interest. So what does the bank do? They add the unpaid interest onto your principal. Your debt is growing while you're making payments. You're going backwards. And the banks let this happen because the alternative is you hitting something called the trigger rate, where they'd have to demand higher payments immediately, which would cause mass defaults. The result is mortgages that were supposed to be paid off in 25 years are now amortized over 50, 70, or in some cases, 90 years. You will be dead, your children will be old, and that mortgage will still be there. When these people go to renew, they're going to need a 40% payment increase just to get back on track. Most of them won't be able to do it. So let's do the math on who's actually at risk of losing everything. Out of the 1.9 million mortgages renewing in 2025 and 2026, about 60% are facing payment increases. That's 1.14 million households. Of those, roughly 40% are facing severe increases of 15% or more. That's 456,000 people. Add in the borrowers already in arrears, the people trapped in negative amortization, and the private mortgage borrowers paying usurious rates, and you get to a number somewhere between 500,000 and 600,000 households at severe risk of default, forced sale, or insolvency in the next 18 months. That's not fear-mongering. That's conservative math based on actual renewal data and payment shock calculations. 500,000 families are staring down the barrel of financial ruin because they bought a house at the wrong time with debt structures that were designed to fail. The renewals are coming. The payment shocks are locked in. The arrears are climbing. The power of sale listings are piling up. And the government, the banks, and the media are all pretending this is fine because the alternative is admitting we built the entire Canadian economy on a foundation of unpayable debt. So here's my question for you. If you're one of the families renewing in the next year, what's your plan? Are you cutting, spending, selling assets, moving to a cheaper city? Drop a comment. And if this video helped you understand what's really happening, hit subscribe, because we're going to be tracking this crisis as it unfolds. The 90-day countdown has started.